While much of the focus on the markets has been on rising interest rates, our next guest says the Fed should really be increasing the amount or pace of its balance sheet reductions in order to help stabilize the economy. He's got two sectors and two stocks to help investors weather this potential storm. Let's bring in Kevin Mahn. He's the president and chief investment officer at Hennion and Walsh Asset Management. Kevin, you just heard Ilan's report. I mean, there's a lot of angst out there right now about the future of the American economy and business investment in this country. There could be a storm coming. It might be the economic hurricane that Jamie Dimon, J.P. Morgan CEO, referenced a few weeks back. Do you feel as though the markets are prepared for this?
Well, Dom, trying to navigate a soft landing is going to be nearly impossible as the Federal Reserve is now aggressively raising interest rates into a slowing economy that's going to, in all likelihood, meet the technical definition of recession after the second quarter. So if and when the Fed does raise by another 75 basis points in July, we know they don't meet in August. They come back in September, and in all likelihood, they'll be looking at a deteriorating economy with slower earnings growth, and that leads me to question just how aggressive they can be. I believe at that point in time, they become less hawkish with respect to raising interest rates and perhaps more aggressive in reducing the size of their $8.5 trillion balance sheet, recognizing that those balance sheet trims actually influence the longer end of the curve and help avoid these yield curve inversions, which are often our indicators of recessions.
All right, so that R word, recession, is coming up a lot more in the kind of general conversation these days. If, in fact, you are looking at that kind of recessionary or possibly recessionary scenario, you've got plays. Is it the true defensive sectors, the ones that are not as sensitive, I guess, to the economic cycles? Are we talking about things like consumer staples, healthcare, and utilities?
Exactly right. We did the research and we looked at previous periods of economic slowdowns that led into recessionary periods. And those three sectors, Dom, actually stood out in terms of relative performance: consumer staples, healthcare, and utilities. Utilities, interestingly enough, are also one of the top performing sectors during previous rising rate cycles. But two names within Smart Trust that we like in two of those areas, quality names with strong balance sheets, attractively priced, with high dividend yields, include on the consumer staple side, Kellogg. Kellogg, of course, being in the news of late because of them splitting up their three biggest divisions. They have a yield of 3.4%. They have a PE of just under 18. On their healthcare side, we like Merck with a yield over 3%, a PE of under 14. And both of these companies have Altman Z-scores above 3. You might ask, what the heck is an Altman Z-score? This was a statistic that was pioneered back in 1968 by an NYU professor to help predict the probability of a company declaring bankruptcy over the next 2 years. What a great statistic to use in an upcoming, potentially recessionary period. So look for those companies with high Altman Z-scores that pay a dividend, strong balance sheets, and positioned in one of those three sectors.